Hello everyone, today I, Krishna of class 12C of Army Public School Gwalior is going to summarize the chapter The Method of Calculating National Income. There are basically three methods for calculating national income: value added method, income method and expenditure method. So we do first value added method. It is the difference between the value of output and intermediate consumption. As it is written here, the formula value added is equals to value of output minus intermediate consumption. The value added is also called GVA or GDP at market price. GVA is the gross value added and GDP is gross domestic product. So value of output is consist of sale plus change in stock. If it is not given in the question value of output, then we have to calculate it by sum of sales plus change in stock, and we can find out change in stock through closing stock minus opening stock. So here we get the formula: GVA or GDP at market price is equals to GVO minus intermediate expenditure. So while calculating value added method, we have to take some precaution or make some precautions. Commission of second hand goods is included, but sale and purchase is not to be included. Imputed value of production for self consumption is included, while service of self consumption is not included. Value of intermediate goods is not included, that we have seen in our formula also. So the next method is income method, which is NDP at factor cost also. NDP at factor cost is domestic price. It is the sum total of factor income earned by household. The formula is compensation of employee plus operating surplus plus mixed income. Please remember that compensation of employee, it is not employer. We can get confused in it. So it is compensation of employee. Here are the components and sub-components of the formula. So the compensation of employee consists of wages and salaries, payments in kind, employers in contribution to social security, pension on retirement, and operating surplus consists of rent plus royalty plus interest plus profit. Mixed income of self-employed, it is the service, or we can say charges, that we do not charge because it is our own property. So our formula is NDP at factor cost is equals to COE, that is compensation of employee, plus operating surplus plus mixed income. So while calculating this method also, we have to take some precautions. Transfer income are not included. Corporate tax, dividends, underestimated profit, and wages and salaries are added separately, not added separately. Sale and purchase of share and bonds are included. Imputed rents of owners occupied house is to be included. Next method is expenditure method. It is also known as GDP at market price. We can find out GDP from this method. It is calculated in terms of expenditure on purchase of final goods and services produced in the economy. Expenditure method consists of private final consumption expenditure plus government final consumption expenditure plus investment expenditure plus net export. So net export is consist of export minus import. So investment expenditure is shortly written as GDCF, that is gross domestic capital formation. It is consist of two things, which is fixed investment and inventory investment. Fixed investment is expenditure on purchase of fixed assets, and inventory investment is stock during the year. So GDCF sometimes is not written directly in the question. If it is written that gross domestic fixed capital, so if it is written fixed, then we have to add up change in stock. And if it is written GDC, net domestic capital formation, then we have to add up depreciation here to get GDCF. Next, if it is written net domestic fixed capital formation, then we have to both change in stock plus depreciation. So this is a flow chart for a better understanding, that is components of final expenditure. That is private final consumption expenditure, government final consumption expenditure, gross domestic capital formation, which is consist of gross fixed capital formation and inventory investment, and last one is net export, which is the export minus import. So we get our formula from here. From this, GDP at market price is equals to PECF, that is private expenditure capital formation, plus GECF, that is government expenditure capital formation, plus investment expenditure plus net export. So while calculating this method also, we have to make some precautions. Only final expenditure is included to avoid error of double counting. Next one is expenditure on second hand goods is not to be included. Next is expenditure and share and bonds and are not included. Transfer payments by government is not to be included. Goods purchased for self consumption is to be included. So let's recapitulate what we have studied till now. So basically we have learned three types of method for calculating national income: value added method, income method, and expenditure method. The value added method have this formula: GVA, that is GDP at market price, is equals to GVO minus intermediate expenditure. Then we have studied some precautions. There are many precautions, but we have studied few of them. Then we have studied income method, which is NDP at factor cost is equals to COE plus operating surplus plus mixed income. We have studied some precaution of this method also. Then we have studied expenditure method, which is GDP at market price. Here is the component and here is the formula. GDP at market price is equals to GECF plus PECF plus investment expenditure plus net export, and these are some precautions. So thank you for watching this video.